if people can make a prediction and they have, a good probability to be right, and you could see where and why they came to those conclusions, that's called value. That person, that chart, that feature, that tool offers you value. To see it work and then to see that you can make it work. Could be a chainsaw. It could be whatever the tool is. And in this case, trying to read where price is going to go is the job. And then having the tools of reading order flow and other people's positions are the tools. So 51 minutes after the hour in this particular session, we had this sell off. Where was it? Back here. Right here. This break right there. Okay. Now, what's going on in here that would help you create a read and an opinion? Let's say that you're bearish, which means you think price is going to go lower. And then also, let's see that we have an area of resistance. Resistance means what? That means that price is going to have trouble getting through this area and go up. Resistance. So we've got our red and green dotted lines as potential resistance. And then we get our laser that gets and stays green. Green is bearish. Green means there's more longs than shorts. More longs than shorts means more future sellers than buyers. And I don't know about you, but you need more future sellers than buyers for the price of anything to go down. We all agree to that. More longs equal more future sellers. More future sellers. Now, a couple of other things, though, that could create a win moment, a fire moment. Ready, aim, fire. We get a pink triangle imbalance, more sellers than buyers, people who want to sell it versus people who want to buy it. And then we also get this blue triangle. It's like, well, Anthony, how about the blue? There's more buyers who want to buy it than sellers who want to sell it. Well, there's information when triangles don't work. In fact, that information sometimes is better when something that usually happens doesn't. It's a clue. You guys know that in any part of life. It's called a tell. When something should happen but doesn't, something's wrong, right? When my dad's air conditioner went out, something's wrong. Why? Because it's supposed to be on and it's not. It's calling for air and it's not coming on. There's a problem. And so HVAC guy comes out and it's pretty simple. They look at the obvious things first, make sure the thermostat's working. I'm not going to get into this diagnosis, but bottom line was you don't go and try to diagnose the hardest possible problem and say the entire unit's bad. They know what the causes might be, and they could check and test and say, boom, we got what the problem is. Because what should be happening isn't. This control board should be signaling to the unit to come on. It's fried. It's not working, right? There's no voltage coming out the other end of it. Now I want to get into how you know that a control board might not be working, but the point is what's supposed to happen wasn't happening. Thermostat was calling for air conditioner wasn't coming on. The market is calling for upside, and the price isn't going up. So when it breaches this blue triangle, okay, that's what I call a breach, that's bearish also. You get a green laser, more longs than shorts. You get a pink triangle, so like an area of more future sellers, and or I should say, more people who want to sell it and want to buy it in this tight area up here, and then you get the more people who want to buy it than sell it. Now, if you get sell market orders that come in and start satisfying the people down in here and the orders down in here, that's what pushes price to go lower. A bunch of buy market orders. You better understand order types if you're in this business from a day trading perspective or an investing perspective. You better understand order types. Not that difficult, and it's going to help you immensely. So now you've got a green laser, you've got a potential blue triangle breach. And then you've got context. What does context mean? Take a look at this chart here. It was sending or setting up all these rotational lows right there at the yellow line. So, the price comes in and just rotates, and then takes off, right? And it comes down and it rotates. The context is it's not going to do that forever. You know as well as I do that if you're long in this market and someone says to you, "Hey, Jimmy, where would you put your stop to get out, your sell stop to cover that long position?" You know what Jimmy's going to say, don't you? Underneath there, underneath the recent lows, underneath the range lows, the congestion box lows, whatever. I guarantee a fifth grader, little Johnny, where are you going to get out of that long? And Johnny says, "Well, right under here, mister." Well, Johnny sucks at trading. When he's wrong, he cries to mommy. All right. Johnny's not good. Little Johnny's not good at being wrong. He's terrible at it. But mommy keeps replenishing his trading account. So he's a spoiled brat, and we like little Johnny's. So if little Johnny quickly says, "This is where I'd be wrong below this yellow line," you could rest assured that most people who are long think that way. If you want to get an idea of how humans think, just look at yourself. How do you think? How do you react? Because you're a human also, right? It's a good tell in predicting what other people might do or how other people are feeling because you have those same feelings also in certain circumstances. Now, point I'm trying to make is if other people are long below a obvious level, and I think this is an obvious level, this yellow line, that's going to precipitate more selling because if indeed I'm correct that longs are going to say, I think I'm going to get out below that yellow line, they're going to put a sell stop down here and here. But the ones who don't put a sell stop there are going to wish they did, and they're going to try to sell it. And those are the ones that get price to go lower. It's not just the sell stops that help push price lower. It's the people that wish they put a sell stop there because they would have sold it. They would have stopped the pain, took their loss, and now don't have to chase it all the way down as it gets away from them. All right. Just because you say I'm wrong below this yellow line of this long position doesn't mean you put your sell stop there. That means that's just where you're willing to admit that you're wrong. And once it starts building and starts to get through there, there's a good chance for momentum, downside momentum. So you see how you build out the story with ideas of where you think price is going to go over the next few minutes, 10 minutes, 20 minutes, 30 minutes. You have a potential breach of this blue box. You've got more longs than shorts over the last 2 minutes. You have an area of a sell imbalance up in here. You could draw that line across kind of. You've got resistance with our VWAPs, our green and red dotted lines. And then you've got people who are going to try to probably cover their long, admitting that they're wrong below that line like we just went over. And then here's the other one. And this one I love the best. You see this white line? That's a VWAP. VWAPs are pretty popular in trading and they're decent. It's volume weighted average price. All right. So it just gives you a sense where price is when you include the volume. So if you get a bunch of volume that happens up here and not a lot that happened down here, well, the VWAP is going to be closer to where the volume was, right? It's going to weigh the volume to plot the line instead of right in the middle. If it's just like a moving average, it's just going to, plot in the middle. But a volume weighted average price, it actually incorporates where volume has come out, which is pretty important. That's what our PWAPs do, but most people don't have PWAPs on their charts. That incorporates where people are long and short from. That aside, here's what's key about a VWAP or any line that you think is popular. If you think a line is popular, that's great. You want to then put yourself in a position for when it's not going to work. I guarantee you, a lot of people wish they would have bought it right there where it came down and then worked, actually worked as support. It was working as support all in there, right? So all the people that wish they would have bought it, you know damn well, it's like the little Johnnies again that are not long. I'm going to get long next time it gets down here. I'm putting my bid. I ain't going to miss it this time, Mom. Right? And so you get all these guys that are just, that's the trap. They're not going to miss it this time. So they're bidding to get long that support because they've seen how well it worked there and how well it was working in there. Happens a lot. That's the trap. That's what you want to recognize. Well, when you fill these knuckleheads, then you create more what? More people who are long and have to chase it and get out. So all these things are lining up for the market to just get momentum. Once it starts to go, it goes. When it goes, it goes. So it's like, it's like one of those things where, um, if it didn't trade 96 half, it wouldn't have traded 90 because you just built the momentum at a certain price and the floodgates open. But you could see this just kind of playing out. You see, boom, some longs come in. You see them fight and get long on the VWAP, and our laser will open up, and you breach the blue triangle. You had the pink one that came in here, and you're just putting yourself in a position to trap more people who are long, and down they go. The breach, though, is the key. When you got that pink one that came out right there, that helped to breach the blue. And then you could just, even if it doesn't come up on the sample size of longs we have, you just build out the story and understand what other people are thinking of doing. If you look at it, like I said earlier, if you want to get a sense of what other people are thinking, well, what are you thinking? You know what it feels like to wish you would have got long in an area of support, and you're like anxious to say, I'm not going to miss it this time, right? Well, if there's a lot of people that think that way, and there are, that's going to create more bearishness. So you could predict this move. And when it happens, you don't feel like you're lucky, and you don't feel like it was a good guess, because that's random and there's going to be no consistency beyond that. You have to have a sense like, hey, I said it was going to rain this afternoon as a meteorologist after 2 o'clock, and right after two, it started raining. A meteorologist be like, wow, you see that? And you don't want to listen to meteorologists or anybody who talks about trading taking victory laps. You want to be good at being wrong. People who talk about only moments that they made good calls, the type. You want to get those that just are excellent at where they're wrong first. Know where you're going to get out before you get in, but also know where other people are going to get out before they get in. You're thinking ahead of them, and that's who you're honestly tracking. All right, you're not tracking a buyer and seller only. You're tracking and trying to find out where these future buyers and sellers are coming from. Where are they going to come from? Because if you know they're coming, then it's really going to stack the probabilities in your favor to make the prediction. If you're a realtor and you list a home, you're managing the expectation of your customer, and that person selling the house are like, well, I think we'll sell this house $500,000. And as a realtor, you go, well, I'm going to tell you this. The last two houses in your area, all right, they sold, and they sold for 490. And I think that if we could get people to come in to see it in the first weekend, then I think that will be around 490. But I'm saying 490 because I've got good comps. But what's key is the flow of people in that first weekend. And all of a sudden, you get more people than you thought that want to see it. So now you're telling these people, hey, I anticipate we're going to get a bid. Now, some realtors out there would say, no, you don't want to get them excited. If you're good at your job, I think you just make predictions and say, hey, this looks good. I'm expecting maybe someone to bid on this. But what you're doing is you're anticipating what's going to happen next with some probability because of what? Future buyers and sellers. But you're comparing that there are more people coming to see this property than were coming to see other properties in that neighborhood. If you have that stat and if you have that information, you have to do this. The whole point of real estate and the comps to trading is you have a lot of this versus you have to be able to compare and contrast to find value. All right. And most people know that technique, agree with that concept, but they get into trading and they ignore it. They're in the price prediction business and they forgot what they've always used their whole life when they buy and sell things. They just bought a plane ticket and they used comps to find the best price. And yet they ignore it when they trade, And so you get order flow, which is what? Order flow is all we're trying to do is this: future buyers and sellers. That's what order flow is. Where are they going to come from? Because if you could predict that where they come from is a plenty, then you could be bullish with some confidence. And I'm telling you, a lot of shorts, like more shorts than longs, equal what? What does it equal? More shorts equal more future buyers. Why is that? Because shorts equal future buyers. I'm not oversimplifying it, but I am simplifying it.